recording right now. So hello everyone, this is Orhan. Today we will be talking about one of the most important chapters of the book. It's chapter 8, and it's risk and rate of return. So basically, this chapter is, do you hear an echo, Cassie?
I'm sorry, what did you say?
Do you hear an echo?
No, I can't.
Okay, no, that's perfect. Okay, if I hear an echo, okay, that's fine. Okay, so let's start with defining investment risk. Okay, so investment risk is the possibility of earning low or negative return. So that's the definition. So what is a return then? So that's now the subsequent question. So return is, so we define return as follows. Okay, so I'm going to write on the screen right now. So return, I will say RT, it means return at time T of any stock is equal to price of that something now, okay, price at time T. So the subtitle or the sub-indices, I'm sorry, the sub-index shows the time and the letter shows the name of the variable, okay? So PT means price of an asset at time T minus price of that asset at time T minus 1, which means if it is daily data, it's yesterday. If it is monthly data, it's last month. If it is annual data, it's last year, okay? Divided by P, okay? Or in other terms, this is equal to, I'm sorry. So in other words, this would be PT over PT minus 1, that's the same thing, okay? So return of anything is this. So let's keep this somewhere. Maybe I should just like write it here at the top so that we might use it. So return is equal to PT minus 1 over PT minus 1. So that's the definition of return. So when we are talking about investments, we would always calculate the return. Okay, so probability of return meaning, investment risk meaning probability of earning negative return. Okay. So the greater the chance of lower than expected or negative return, the riskier the investment. So the higher the probability of negative return, we call it risky investment. Okay. So how do we just measure it? So we measure it using something called probability distributions. Okay, probability distributions shows us the probability of earning specific returns with the corresponding probability. I will just show you an example right now. Okay, so let's take a look at a real-time example. Well, it's not a real-time, but it's the historical realization of Apple return. Okay, I think of Apple. Yes, exactly. So this is a historical realization of Apple. So there are 250 days. So this column, for example, shows that we had almost like 90 days. So this shows you the number of days. Okay, so this is the number of days. We had 90 days out of 250 days with return between 0 and 0.01, which means 1%. Okay, so 90 out of 250, it kind of gives us the probability. Like, okay, so 90 to 150, it's more or less, I'm just like approximately saying, it's more or less like 40%. Okay, so historically, this year, between those days, March 2016 and 2017, Apple stock returns, okay, the realized returns happen to be showing like a 40% probability of return between 0 and 0.1, okay, or 1%. Okay, similarly, between 0.1 and 0.2, it's more or less like, I don't know, 10%, etc., etc. Okay, so these are not the exact probability, but these are what happened last year. So I might use it as a proxy and saying that, hey, last year it happened 10% of the time. So it might be the case that next year it will be more or less the same. So there's kind of assumption here, which does not necessarily be true, but it's just, I draw this graph just to give you an idea, okay? This is called probability distribution. So it shows us like every single range of probability, every single range of return with the corresponding probability. Okay, does that make sense, Casey?
Yeah, I think so. So it basically just shows the skew of it, of the probabilities.
Well, exactly. Normally, okay, let's go back to the previous slide. So normally we should have graphs like this, which shows us the probabilities, but nobody knows the probabilities, okay? So except God. I mean, we are human and nobody knows what's going to happen in the future. So we kind of use this graph as a proxy. So this is what happened last year. So I might say, hey, more or less, this will be the probability, for example, next year. I might assume that, okay? But anyways, if these were true, we would call this probability distribution, okay? So I draw this line on top of it just to represent what's going on. This is Apple. Now let me show you Bank of America, okay? So to the right of the graph, you see some numbers, which I will explain in a moment. But please pay attention to the very first and the easiest one. This is count, okay, number of days. So there are 250 number of days here where I'm measuring the Apple returns, okay? So Apple returns, now let me open a Bloomberg window here. So this is Bloomberg. I was trying to show Apple. So this is Apple's stock prices. Last year. Okay, so this is from 2019 to 2020. This is stock prices. Okay, it's not stock returns. Once we get the stock prices, you calculate the returns. For example, look at here. Okay, so this is more when you bring your mouse on it. Okay, so you see that it's $80. Okay, you see this thing? It's $80. So if you bought Apple here for $80, and then say, for example, you sell it here, which is, to bring your mouse on it, then which is $134. Let's say $140. Okay, go. So return here is going to be price, last price, minus previous price over previous price, okay, which is 60 over 80, okay. It is more or less, let me calculate that. It's more or less 75%. Okay, so 75% of return, so this is 75% return. Okay. So you calculate these returns. This is not data, by the way. This is between January and also this is 6 months return. Okay. So what we do here in the previous graph is to download these stock prices, okay, whatever you see here, okay, and then we calculate every single day return, so from here to here, from here to here, so we get every single returns for every single day, okay, which I will show you a moment later. I download the prices, and then you calculate the returns and you draw the graph. I mean,
That makes sense because don't most like stock, like if you were to invest, don't they usually tell you your daily return and then like your total return?
exactly. Okay. For example, let's go back to let me open a finance page. Okay, finance. Yahoo.com. Okay, so whatever you see here, you see the percentages here. These percentages are daily percentages. So S&P 500 is growing 0.8% with respect to yesterday. Dow Jones 30, it's 1.20% with respect to yesterday. NASDAQ is 0.74 with respect to yesterday. These are all daily returns. Was that the thing you were asking?
Yeah, that makes sense. It's all slowly coming together.
Okay, perfect. So we are not in a hurry, so we are just building the blocks, okay? Um, so let's look at the numbers to the right and left, okay? So let's look at the numbers to the right first. Let me just like delete that cursor. Okay, so this is Apple once again. This is Apple probability distribution. So let's look at those numbers. Okay, so here, the mean of apple between those days. Okay, so I have 250 days, and I calculate all the returns, and the mean return is 0.14, which is not even 1%. Okay, so Apple ended up with 0.14% of return on average last year. Okay, and then the maximum was 6.4%, almost 6.5, and the minimum was negative 6.2. It is 2016 and 17, by the way, okay? So let me show you how to do this, how to just put these numbers together. Okay, so are you on the computer or are you on the phone?
I'm on a computer.
Okay, perfect. So you can log into Canvas and you can do what I do, if you can. So when you can log into Canvas and then week 7, at the end of the week 7 module, there's something called apply stock example in Excel. You can download it and then we can go through together. Would you like to do it or would you like to watch me?
I'm downloading it now.
Okay, perfect. By the way, I prepared a video just below it. You can watch it. Okay, just click enable editing. You should be seeing two stocks there, Apple and Boeing.
Yep, I've got them.
Okay, perfect. So when you open it, these yellow cells are the cells to fill. Okay, so let's fill it together. So remember the definition of return is today minus yesterday, but for the first day there is no yesterday, so skip the first row. Okay, just come to the second row, which is fifth row here. Okay, and right here equal. So open a parenthesis. So today, which is B5, minus yesterday, which is B4, divided by B4. So this is going to be Apple returns. Are you think?
Yeah, I've gotten all of them for the
Oh wow. Okay.
return.
Okay, I was waiting for you. I'm sorry. Sorry, I don't just let you know.
Oh
Okay.
no, you're fine.
Okay, let's double click on it. So please make sure that you more or less, not more or less, you get exactly the same numbers. Do you get the same numbers, Jesse?
Let's see here. Yep, those are all the same.
Okay, perfect. So now let's scroll down, all the way down. Okay. So find an empty cell here at the end. And right here, average or equal average, and open the parentheses. So it calculates the average of both people. And you should get 0.08%. Did you get it?
Not quite there yet.
Okay. Equal average, open the parentheses and select the whole column. That should be 2,400.
Yep, that's what I got as well.
Okay, perfect. So this shows that Apple on average, Apple returns on average, daily return of Apple was 0.08% for the last 10 years, by the way. So this starts from 2011, comes all the way down to 2020. Okay. So this is one way. The other way, which is even more useful, so you can click the data, and you might have this data analysis to the right. So when you click data on the toolbar, and there should be data analysis to the right. If you don't have it, which is normal, I can show you how to get it. So you get this data analysis to the right here.
Let me see here. I might need to make my screen bigger. Is that just on your home page or the home tab? No, under.
Oh, it's on the data tab. So when you click on the data tab, there should be data analysis to the right. If not, which is normal, okay, because I installed it, you might not have installed it. So don't have
No,
it.
I
Okay.
don't think I have it.
Okay, click file, and there are options here. So click file, and there's options at the end. File options, and there's add-ins there. File options add-in.
All right, sorry, you gotta wait up a second.
Oh, that's fine. That's fine. That's totally fine.
I'm trying to translate them a little from a Mac.
Oh, you're it's Mac. Huh. Mac.
Let me see.
Just we are looking for the add-in. It might be somewhere.
Some sort of add-ins. Let's see here.
Just Google it. Okay, so once you get the data analysis, if it is Mac, it is file tools and add-ins. If it is PC, then file options and add-ins here. So there's tool packs should be selected. Okay, so I'm saying this for the record. Okay, so once you have the data analysis, click data analysis. Okay.
Do you have to be in a specific cell?
No, I mean, I'm going to show you now.
Okay.
Just you don't need to. So click data analysis, and then there are a couple of analysis tools there. Just click the descriptive statistics.
Okay.
And then okay, now select the full column, okay, that we prepared at the moment for the yellow column. So either select it manually or Control Shift up arrow or down arrow, select the full column, okay. And then select the column for the input range, and just click and select the summary statistics, nothing else.
All right.
Okay, and then hit OK, and you will see the statistics of Apple returns for the last 10 years. Something like that. Did you get the numbers?
Yes.
Okay, perfect. So I'm going to select these numbers and then hit on the home screen the percentage sign just to make sure that these are all in percentages with two decimals. Because these are not sales, neither profits nor revenue. These are returns. So returns are expressed in decimals in percentages. So that's why it's converted to percent. Okay. So mean, which we calculated a moment ago, is 0.08, right? Okay, so it should be the same. Okay, so we have 2,404 days, which is 10 years. Okay, and this is the mean of Apple. These are median, standard deviation, which we will report in a moment, and maximum and minimum. Okay, so I'm just like showing you how to calculate the statistics for a real-life data set. Okay. For the moment, let's keep this number in mind. So mean, which is the average of a number set. So let's go back to our presentation. So we were comparing Apple. So this was Apple global distribution. So let's keep Excel there. So let's leave Excel there. Let's go back to the the presentation. So this is the Apple distribution, and then these are the descriptive statistics of Apple. Okay. By the way, just to make sure that people are not confused, this data set you see on your screen right now belongs to 2016. Okay. What we did on Excel right now a moment ago is a realized data of the last 10 years. Okay, so that's what numbers might be different. But, the idea is the same. So this is Apple, and now I'm going to show you, this is Bank of America, okay? So the red columns, okay? As you might see, red columns are more dispersed than blue columns, okay? You see Apple returns are higher, so they are more concentrated in the middle, but Bank of America returns have very dispersed data in the tail. You see those? Okay, so this is Bank of America's mean and Bank of America. So let's look at the numbers for a second. Okay, so this number, Apple's mean is 0.14. So do you see the Bank of America's mean, Cassie? Average return to the left.
Yep, I can see them.
Okay, and what was it? The mean of Bank of America, what number is it?
The mean is 0.27%.
Okay, perfect. So now let's compare them. Bank of America's mean is higher than Apple's mean for the last 1 year, 18 months, 2016 and months, 2017. Now let's take a look at something called standard deviation. I will explain a moment. Standard deviation is 1.2% for Apple and then 1.7% for Bank of America. Okay, so Bank of America's mean is higher than Apple, so it makes sense by looking at the last year, of course, that year, it makes sense to say that, hey, and Bank of America provided more returns to their investors, so let's invest in Bank of America instead of Apple, okay? But that's not always the case. We don't look at only the mean or average return. We also look at the standard deviation, which measures the risk, okay? As I will explain in a moment. So the higher the mean, the higher the risk in general, okay? So you can't say that, hey, Bank of America makes more sense, okay? Even though on average it provided you more return, but it was with more risk, okay? So you have to bear the risk in order to expect a higher average return. Does that make sense now? A little bit more.
Yeah, that makes sense.
Okay, so these are realized data, by the way. Okay, so let me make sure that there are two types of data. The first one is probabilistic data. This is for the future. So we see that. Or second, realized data. Okay, so what we look at right now is the realized data. Okay, so which happened. We are looking at realized data. Now let's go back to probabilistic data once again. So if we didn't know the reality, we might attribute some probabilities for certain outcomes. For example, someone might prepare a report for the United States or for some company might say that, hey, there is 0.1, which means 10% probability that we will end up with this report. There's 20% of probability that we will end up with this report, 40% probability we will end up with this report, etc., etc. So for every single return, there are corresponding probabilities, okay? So let's define what expected return is then. So if there are probabilistic data, okay, there's something called, you don't have average, okay, so you can't average it because it didn't happen. If there are probabilities, so we call it expected return. Expected return is calculated by multiplying every single probability with the corresponding return, or every single return with the corresponding probability, more or less, okay? So this one's defined by Pascal. So he was a very famous scientist, and then he came up with this calculation like years and years ago. So we multiply the probabilities with the corresponding return. So this probability times this return, okay? Here. And then second probability times second return, and third probability times third return. etc., etc. And you add those numbers up, it gives you something called an expected return. So out of all these, like five returns and five probabilities, okay, I see that, hey, on average, I'm expecting that this stock or this investment will yield me for 20, I'm sorry, 12.4% of return. Okay, so it is the sibling or the brother of average. So if you have a realized data, you would have an average. If you have probabilistic data, you have expected return. Okay, because you can't calculate the averages because it doesn't happen. You just know that there are probabilities, and you can't simply average this because the weight of 15% is much higher than the weight of negative 27%. So you can't simply average those. You have to multiply with the corresponding probabilities. Bottom line, okay, bottom line, if you have a probabilistic data, you will have returns with the corresponding probabilities. So if you multiply the probability with the return, you will get something called expected rate of return. So basically, you are expecting that return to happen in the future as an average. Okay. Is this understandable? Do you have any questions about this?
That makes sense. I don't have any questions.
Okay. So, for example, if let's make an example that is a simple example. Assume, for example, that there's Apple. I'm expecting Apple. Like there are two probabilities. We are 60% probable. I'm expecting that its return is like 5% more. Okay, data returns are much lower, of course. And with 40% probable, I'm expecting that it's going to yield me negative 3% return. Okay. So question is, what is the expected return on Apple for tomorrow? So what will you do? Very simply, expected return on Apple is going to go up.
Wouldn't you multiply them together and then
Yeah,
add them
multiply, just keep counting numbers, please. So multiply 0.6 by
times 5%,
5% plus 0.4 times
3%?
Okay, so this makes 3%, this makes 1.2%. If you sum them up, it's 1.8%. So this will be the expected return of Apple. Okay. So this was 98 precise. Okay, so let's do this. Okay, so there's another thing called standard deviation for probabilistic data. I'm not going to go to the details, but I will give you the idea. So there's the formula is here, there's calculations here. But as I said, I don't want to complicate the things out. But anyways, the bottom line is this. This is called standard deviation. So there are probabilities again, so you also use probabilities. You multiply the probability with the term, which is every single return minus the expected return. Okay? But the idea is that standard deviation measures how much the stock deviates from the mean on average. Okay, so let me give a visual example here. So I'm just putting the next slide. Okay, so let's use this empty sheet. Okay, assume for example there are two stocks. Okay, stock A and stock B. Okay. Stock A's price is somewhere like this. So this is time, and this is stock. And at the same time, let me draw them the same graph. I'm going to use blue for it. Okay, look at B. So this is B stock. So even though on average they are both yielding, say, something like, I don't know, 2% or 3%, 3%. So the average of A is 3%, the average of B is also 3%. Okay. But what is different between A and B is B might be too much volatile. So there are like extreme good values, extreme good values here and extreme bad values here. Okay. So let me give an American example. So say A is 3%, 3%, 3% for 3 days. B is 1%, 3%, 5%. Okay. So even though when you calculate the mean, their means are the same, right? The mean of A is 3, the mean of B is also 3, right? So you add the numbers and divide it by 3. Does that make sense?
Yeah, that makes sense.
Standard deviation is how much your data deviates from mean. So looking at A, none of the data deviates from the mean. So mean is 3, so nobody deviates from mean. Okay, so standard deviation is 0. But when you look at the B, the first data deviates by 2 from the mean, so mean is 3. Okay, the first data deviates 2. Second data does not deviate from 3, and the third data deviates by 2. Okay, so on average, these data deviate from the mean more than A, so it could be something around 2. Okay, so B deviates from the mean than A. Okay. So what I'm trying to show you is I don't want to bother you with the standard deviation calculations, but I'm trying to tell you the intuition of standard deviation. Standard deviation measures how much your data deviates from the mean. Okay. So that's why it's kind of shows you how volatile your data is, how unpredictable your data is. Remember the very first graph? This was A. Okay, once again, so A was the red line. This is A, and this was B. So B deviates from the mean more than A does. Okay, so we call B a risky stuff. Okay, just because you don't know, you might end up somewhere here, or you might end up somewhere here. But A is more stable, so you can't end up like too different or too far from the mean. So you either end up here or here, which is not too far. Okay, so this is called standard deviation. So standard deviation measures the standalone risk or the deviation from the mean. Okay, in finance, we use standard deviation to measure the risk. Okay, the higher the standard deviation, the higher the risk. Okay, so let's go back to our Bank of America example. Okay, so look at Apple. Apple is more concentrated here. Okay, so it's like more concentrated. Most of the data is here. You see that? Almost 90% of the data is here. But when you look at Bank of America, okay, so this is Bank of America, it's much more dispersed. So there are too much deviation from the mean. Okay, you see those? So the mean of Bank of America, which is 0.27, which is somewhere here, so the mean of Bank of America, but it deviates too much from the mean. So returns, some of the returns are too high, which is good for us, but some of the returns are too low, which is very bad for us. Does that give you the intuition of standard deviation testing?
I'm sorry, what was the question?
I'm saying that do you more or less get the idea of standard?
Yeah.
Okay. So we somehow are okay. So we calculate the standard deviation for. So this was the question, the initial question. So there's one investment here. We calculate its expected return. I showed you how to calculate the expected return, by the way. So you have to know this by heart. But for standard deviation, just try to understand the meaning of standard deviation. I'm not going to ask you to calculate it, but you have to understand the meaning. So on average, even though the expected return of my investment was 12.4%, on average, it deviates this much from the mean. So it might be somewhere add 20% on it, it makes 32%, and subtract 20%, it might be somewhere negative 8%. So this stock or this investment might totally be between these two ranges. So 20% goes to the standard deviation. We use the word goes in finance for standard deviation. This shows the risk of my investment. Okay, so Standard deviation measures total or standalone risk. So if you have one stock, if you're looking at standard deviation of that stock, you might say this stock is risky or this stock is less risky, okay, compared to others. So the larger the standard deviation is, the lower the probability that actual return will be close to expected return. Okay, so let me draw a graph to understand. So assume, for example, this is the expected return, this is the mean. Okay, so if there's a larger standard deviation, the distribution will be something like this curve, like this. Okay, so this is large standard deviation. Large standard deviation. It's the larger standard deviation, the lower the probability that actually will be close to expected. Okay, now let me show you, let me draw you lower standard deviation. If stock is lower standard deviation, stock, so most of its returns are around the mean somewhere. So this is low standard. Do you understand that? Okay, the second thing is, or maybe the third thing is called coefficient of variation. Coefficient of variation is the deviation of standard deviation by the expected return. Okay, so we calculated that standard deviation was 20%. Calculated this. We calculate the expected return was 12.4%. So when you divide those numbers to each other, you will get 1.6%. Okay, so basically, coefficient of variation is a standardized measure of dispersion. Okay, so the higher the coefficient of variation, the higher the risk per return. Okay, so basically, let me again give an example. Assume, for example, there are two stocks again. Okay, let's say stock A and stock B. Okay. So let's say this is expected return, and this is standard deviation. Assume that the standard deviation, which measures the risk, okay, is 40% here and 20% here. Okay. And then say expected return is say 10% here, 40%. Jesse, are you there?
Yeah, I'm here.
Okay. So once again, standard deviation measures the risk. So by looking at the numbers only, you would say that A is more risky than B. Okay, by looking at the numbers. But you have to standardize it. So this stock, which is stock A, provides you 40% in return for the risk you are bearing. Okay, so the risk is 40%. The expected return is 40% too. But this stock, even though it looks less risky, the expected return it provides is 10%. So we calculate this coefficient of variation. Okay? Coefficient of variation is risk divided by expected return. So 40% by 40%, it gives you 1 here. 20% over 10%, it gives you 2 here. So when you standardize the risk by the expected return, coefficient of variation is higher. So for every single return, you more or less have to bear 2 times more risk in B than in A. So B is, even though it looks less risky, it is not. Okay, the risk per return in B is far higher than risk per return in A. Does that make any sense?
Yeah, that makes sense.
Okay, so if, for example, I were the investor, I would go for A, okay, not B. Okay, so it's a preference, by the way, there's no correct answer. But if I'm looking only risk per return, okay, risk per return, so sigma divided by R, which is called coefficient of variation. Risk per return is far higher here in A than in B. Okay, so let me go back to the definition once again. So coefficient of variation is risk per return. Okay. So let me write it here too. So the higher the coefficient of variation, okay, the higher the risk, the standardized, which means when I say standardized, I mean risk per return. So this is basically the idea of this chapter, okay? So we are measuring the risk and then we divide the risk per return. Okay, it's kind of, you are going to a restaurant and then an expensive restaurant does not necessarily mean that these guys are just like deserving the money. Maybe, okay, so you are paying $20 per menu, okay, in restaurant A. In restaurant B, the menu is $10, but $10 restaurant might not be providing you health quality. Maybe they are providing you a quarter of the quality. The food we are eating in restaurant A, the expensive restaurant, maybe five times higher quality than the other one. Okay? So don't look at the number only, just don't look at the menu and say that this is, they don't deserve it. Okay, the price is one thing, but the other thing is the quality. Okay, maybe they are providing you much higher quality than paying twice the price. Does that make sense?
Yeah.
Okay, so this is called coefficient of variation. Let me take a look at the clock. So let's see, let's pause for a couple of minutes and then continue. Would that be okay for you?
That's fine.
Okay, so let's pause. You don't need it. Do you hear it, Cassie? Or is it?
No, I can't hear that.
How about now?
Yes. Okay, so that's basically the meaning and the definition of diversification. So how can we measure diversification? So let's see, for example,
that we have a portfolio of two stocks, and it's created $50,000 invested in both stocks A and B. Okay, so we are going to calculate portfolio's expected return using the expected return on each single stock. Okay, so let's take a look at the definition here. So if we have a stock with two returns, okay, so say A's expected return is 2%, B's expected return is 10%. Okay, so this is given, okay, so we know these numbers, okay, 10%, 2%. So what is the return of what's the expected return on my portfolio? Okay, if it is 2%, 10%, so what's the expected return on my portfolio? Okay, now basically you have to multiply the expected return of each single stock with the corresponding rate. Okay, if you are equally dividing your stock, okay, into, like, if you have $50,000, you invest $5,000 in A and $5,000 in B, then it's called equal rate portfolio. Okay, so 50% in A, 50% in B. It might not always be the case. So anyway, so the formula is return of portfolio is equal to first rate, rate of Apple, or rate of A, let's say, rate of A times return of A plus rate of B times return of B. In this case, rate of A's rate is 50%. So I invest 50% of money in A, and then times its expected return, okay, which is 2%, plus, okay, plus rate of B, which is 50% times 10% of this is return. Okay, so these are returns. These numbers in square are the rates. Okay, since they're equal weighted, unsurprisingly, it's going to be 6%, just the middle. Okay, so the middle of the average of 2% and 10%. Okay, but it might not always be the case. Okay, so this was, once again, this is A, 2%. This is B, 10%. So the portfolio's expected return was 6%, just the middle. It's because A and B are equal weighted. If the weight of A, okay, was 90%, say you invest $45,000 in A and $5,000 in B, then this portfolio return would be closer to A. Okay, so you do the math anyways, but what I'm saying is it's not always the average. Okay, so this is called portfolio expectation. There is also portfolio risk, okay, which I will not show. Okay, it's more complicated than the single risk, but its interpretation is more or less the same. Okay, portfolio risk is the standard definition of your portfolio. Okay, so we might just like I will show you portfolio risk using an Excel, which would make things much more easier than formulas. Okay, so now let's take a look at the next graph. Okay, so this is an Excel sheet. So do you have your Excel sheet still open, Jesse?
Do I what? I'm sorry.
Do you still have your Excel sheet open still?
Yes.
Okay. So you can copy this thing here and paste it to Excel, just like first three columns. Oh, by the way, do you have your PowerPoint open? No.
No, I don't. But if it's just a table, I can just make it real quick.
I didn't make it, or you can copy it from Canvas. So from Canvas, by the way. So go to home screen. It is week 7, lecture, chapter 8. Just click on it. You can download the PowerPoint. And on the 15th slide, you will have this Excel. And just copy and paste it. So there it is. Okay, tell me when you're ready, okay? Okay, now if you paste it, so what I'm going to do is I'm going to calculate the mean of stock W and stock N. Okay. So go to the last row of this table and write their average, like we did in Apple, and select the returns. So in 2000, so we have the returns from 2008 to 2012. Okay. Just copy. I'm sorry, just write average and select those columns and calculate the average as 50%. assume there are two stacks, stack V and stack M, okay? And the average of stack M is 15%. And then when you do the same thing for drag and drop, you calculate stack of stack M average is also 15%. Did you do that?
Yep, I've got what you got.
15, right? Did you get 2 15s?
Yes.
Okay. So let's calculate standard deviation. So that's why I didn't show you that standard deviation exact calculation in a minute, in a second, I'm sorry. So just write here equal again, and then write STDEV, okay? That is STDEV, nothing else. And then select stack B, so it calculates the standard deviation of stack B, okay? It's 0.25. Or 25%. And do the same thing for M, and you will see that standard deviation goes to 25%.
Yep, I got those as well.
Okay, so now you have two stocks which are equally risky, right? 25%, the standard deviation is 25%, and their average or their mean is also 15%. So they are more or less the same stock, okay? So you can understand this from the chart too. So when you look at the chart, so this chart, the orange one shows stock M, and the blue one shows you stock B. Okay, so they are equal. Just they do the opposite movement. Okay, when one goes up, the other one goes down, and one goes up, the other one goes down. Okay. Now let's form a portfolio. Okay, right here, portfolio. Okay, I'm going to form a portfolio, and then right here equal. Okay, do you see my screen?
Yep, I can see it.
Okay, so I'm going to form a equal weighted portfolio, okay, which means that I'm going to multiply first stock with 0.5 and second stock with 0.5. Okay, so 0.5 times first stock, 0.5. Okay, 0.5 times first stock and 0.5 times second stock. Okay. It's on my screen, you can see that from there. Okay, when you hit enter, you will get 0.15. Did you get that?
Yep, that's what I got.
Okay, now drag and drop until 2012. Okay. So what did you get?
15 for everything.
So this is what I call bundle of finance. Okay, so this is kind of land, which means magical finance. Okay, so seriously, it's very, even though it's intuitive, it's very interesting just because you are combining two risky stocks and you end up with a stock whose, let's calculate the average of my portfolio, okay? And you drag the average to the right from here, or calculate the average, or calculate the standard deviation of your portfolio. Okay, just drag it to the right, you'll get 15% average for your portfolio, and then 0% for standard deviation for your portfolio. They don't move at all, right? Just because that's why their standard deviation should be 0%. And 0%. Can you please confirm that you get 15 and 0? That's it. That's it. Did you get the same numbers?
Yeah, I did.
Okay, so it's 0% right here.
Yeah, for the standard deviation.
Yeah. So standard deviation of your portfolio is 0, which means you literally eliminated the whole risk. So there's one stock whose, let's go back to our presentation. So there's one stock here, stock I would call B. Anyway, so stock B, which is the blue stock, is risky, right? The orange stock is also risky, okay? So it is also risky. So it moves up, down, okay? Also, you combine two risky stock. At the end, you get a portfolio whose risk is 0. There is no risk at all, okay? So that's magical finance. Okay, this is real, by the way, okay? What is the idea here? The idea is you have to combine two negatively correlated stocks. So when one goes up, the other must go down. So the higher the correlation, okay, I'm sorry, the lower the correlation, the better, okay? So lower correlation meaning they should be opposite the moving, okay? Correlation is, let's go back to our Excel sheet. Let me tell you what correlation is. Okay, let's open this Excel sheet, which we downloaded in the class. So this is what correlation is. There's a little tiny graph here. So correlation is a number between -1 and +1. Okay. The higher the correlation, meaning the closer you are to 1, the positive or the higher the correlation, the higher the co-movement between two variables. Okay. Meaning if two variables are moving together like this, so this is one stack, for example, and let's say this is the other stack, if they are totally moving in the same direction, this means that they are positively correlated to 1. Okay. Did you get this?
Yep.
Okay. Now let's give an example of negative correlation. So if one stack goes up, okay, negative correlation meaning they are moving in the negative direction. One goes down, up, down. So they should move in the opposite direction, like a really bad couple. So you want to go to the cinema and your spouse wants to go to a match, okay, game, I'm sorry. So, and then you change your mind, you want to go to the game, and he changes his mind to go to the cinema. So just like you are moving in the opposite direction. In finance, this is the best thing ever you can get, okay? If they move in the opposite direction, this is the best thing you can get, okay? So this is -1 correlation. Okay? They are moving in the negative direction, okay? So between -1 and +1. +1 is the highest correlation, -1 is the lowest correlation. In finance, we are looking at lowest correlation possible, okay? The lower the correlation, the better, okay? Because, can you guess the idea, the logic behind it? The intuition? Because if they move in the opposite direction, they kind of compensate the risk, okay? So when this goes up, so you can keep this red line in between stable, okay? So when they move in the opposite direction. How do we calculate correlation in Excel? Well, let's open this Excel sheet once again. Cassie, can you please open that, the very first Excel sheet we downloaded?
Yep, I've got it.
Okay, so let's do the same thing for Boeing. Okay, let's calculate returns for Boeing. Just drag it to the right, you will calculate the returns for Boeing, and then double click and it will calculate the returns for Boeing. Now we have Apple returns and Boeing returns. Okay, can you please make sure that you get the same numbers?
Yep, I got the same.
Okay, perfect. Now let's click anywhere. Okay, click anywhere in the cell, and right here Correl. Okay, Correl. Okay, it calculates the correlation. And then there should be two arrays. For the first array, select Apple, select the Apple column, Apple returns column, down into select comma, and then select the Boeing return and close the parentheses. So it should be something like this. Right Correl and select Apple and Boeing simultaneously at the same time. and hit enter, and you'll see this number. Please make sure that you get the same number. 43%. 4.2.
Yep, that's what I got.
Okay, so let's go back to our chart here to the right. So there is 43. 43 is somewhere here, right? Okay, somewhere here. It's closer to 25. So it's just an example. Okay, so this is how we calculate the correlation between two stocks. So the lower the correlation, the better. This is not very high, but it's not very low either. It's on the positive side. Our best stocks, I mean, the best scenario would be to have two stocks which are negatively correlated. But it's very difficult to find negative correlation in reality. Well, in theory, it's the best thing. So -1 is the best thing. But in reality, most of the stocks, they move together. Okay. So let me show you an example. So this is Apple, for example. This is Apple. I'm going to add. Okay, so I'm going to add. I don't know. Let's say Amazon. This is real life, by the way. So look at Amazon. Okay, so this is Apple. The white one is Apple. The blue one is Amazon. Now let's add. I don't know. And then what else? So let's add one more. Okay, as you can see, well, don't look at the numbers nominally, but just try to follow the trend. So when stocks go up here, all of the stocks went up. Okay, more or less. Okay, and maybe it's a general rule of thumb. Okay, it's not one of those. But as a rule of thumb, generally when market goes up, most stocks go up. When market goes down, most stocks go down. Okay, when market goes up, some Apple and Amazon, they go up more, of course, on this graph. Twitter and IBM did not go up too much here, but they went up too. Okay, not too much, but a little. But it's very difficult to find two stocks which are negatively correlated, meaning that one goes up, the other goes down. It's very difficult because more or less the market derives most of the stocks. Okay, so basically it's possible. It's possible. But let's see now. Open the Excel sheet once again. There's another sheet called 5 stocks here. Okay. Do you see that?
Yeah, I've got it.
Okay, so now let's calculate the returns for all of them. Okay, it will take too much time. Just calculate one for the Edmund Technologies. Okay, and then drag and drop to calculate everything. Drag and then double click here. You can watch me if you don't want to do it. If you want to do it, I can wait. If not, you can watch me.
Yeah, I think I'll just watch.
Okay, fine. So I calculated the returns of 5 stocks. So we have Edmund Technologies here, Advanced Auto here, Apple, Boeing, and Boston Properties. Okay, so I'm going to use this data analysis tool. There's correlation here, so I include correlation. So I'm going to select all of these 5 stocks. Okay, so I'm going to calculate the pairwise correlation. Okay. So once again, I'm going to select this 5. Okay, now I have, these are the returns. You see those, for example, the returns of Apple. First of all, they are all positive. Did you see that?
Yeah, I can see it.
So most all of them are positive. Okay, so first of all, it's very difficult to find negatively correlated negatively correlated stocks. But some stocks, so these are theorized. For example, this is Apple. Okay, let's get Apple. This is Apple versus Advantic. This is Apple versus Apple, Apple versus Boeing, Apple versus Boston Brothers. Okay. Anyway, so some of them are more positive. Look at this one, for example, 49. Boeing versus Boston Brothers. They are more correlated. It's closer to one. But look at this one. Okay. This is Agilent Technologies uh, versus Advanced Auto. One of them is auto company, and the other one is technology. They are less correlated. Okay. Oh, this is even less correlated. Look at this one. Apple versus Advanced Auto. Okay. One of them is technology company. Did you see this number, by the way? Did you see this number? The one in yellow. It is the lowest possible in this graph, at least. It tells us that the Apple is less correlated with auto than the others. Okay. So which means if you invest in two of those companies and if you want to decrease the risk, you should invest in Apple plus the auto company. So you can't find negative, it's very difficult, not you can, it's very difficult to find negatively correlated stocks. So you should invest in stocks with the least correlation possible to decrease the risk. Okay, do you understand what I mean? That's it.
Yeah, that makes sense.
Okay, so this is negative correlation, and this is positive correlation. Okay, you see positive correlation when you invest in positive correlated stocks. So the previous graph is for negative correlated, we eliminate the risk. Okay, now the next graph shows you the positively correlated stocks. So there are two stocks, which means that they are moving in the same direction. You see when one goes up, the other one goes up. When one goes down, the other one goes down all the time. They are positively correlated, which is one. And that's why standard deviation is somewhere between those two numbers. Okay. It's not zero. Do you have any questions up to here?
No.
Okay, so creating a portfolio. When you create a portfolio, so you begin one stock and you add randomly selected stocks to your portfolio, and those random, not random, those added stocks, laterly added stocks, they should be least correlated possible. So portfolio risk, okay, standard deviation of portfolio decreases as stocks are added because they would not be perfectly correlated with the existing portfolio. Okay. So the least correlation, I mean, the more stocks you add, you decrease the stocks as long as they are not correlated. Okay, if they are positively correlated, you cannot decrease the risk. Okay, so if I ask a true false question like this, what would be your answer? So the more stock I add to portfolio, the more I decrease the risk. Do you think this is true or false?
It's true.
No, it's not true, because the more stock you add, the lower the risk, as long as they are not positively correlated or perfectly correlated. Okay, if they are perfectly correlated, you can't decrease the risk. Do you understand what I mean? For example, look at this example. Assume I have stock M only. Okay, its risk is 12%. Okay, now I add stock B, which is positively correlated with stock M, and then now the risk increased from 12% to 18%. So you increase the risk. Did you understand what I mean?
Oh yeah, now that makes sense.
So the newly added stocks must not be like perfectly correlated. If they are perfectly correlated, then it's terrible for you. You increase it, not decrease it.
So would that be like if you had like a technology company and then you add another technology company, since they would be
Well, it's a perfect example, Cassie, thank you. It's a perfect example. So negative correlation meaning, so you have checked from Excel, but the meaning, the intuition of negative correlation is right, what you say. Okay, negative correlation is if you already invested in Twitter, you must not invest in Facebook, okay, because they are more or less the same sector, same industry. Then something happens to that industry and all of them would go down. Okay, when something good happens, they will go up. So when you already invest in Twitter, for example, you must invest in something totally different sector, say auto sector or pharmaceutical sector or I don't know, consumer staples sector. Does that make sense?
Yeah, that makes a lot more sense.
Okay, so you must not invest in the same exact companies from the same exact sector. Okay, so the next thing is, so how much can I decrease the risk? I can eliminate the risk. Sorry, look at this graph once again. So in this example, I eliminated the risk to zero. Okay, this is a very extreme example, but yes, you can decrease as much as possible. There's something called, remember the video, there's something called market risk. So say for example, you have one stock, okay, so you have one stock and you are here. Okay, so your portfolio risk is 30%. So you added 35%. So you have one stock, its portfolio is 35%. So you added one more stock, which is negative correlation, so you decrease the risk 30%. You added one more stock and one more stock. So you decrease the risk as long as you added negative correlated or less correlated stocks. Up to one point. From some point, but you can't decrease just because there's something called market risk. Okay. So there are two risks in finance. The market risk, which is called systemic risk. Okay. The other thing is non-systemic. So if you invested in Facebook, okay, Facebook, invest in Facebook, do not invest in Twitter. Okay. Okay. So this is something called non-systemic risk. But if president dies, for example, in the country, well, you can't eliminate that risk. They will all go down. Okay. So you can eliminate the Facebook's risk by not investing in Twitter. You can invest in, I don't know, let's say, auto company that we have seen a moment ago. Okay, auto company. So that's the best thing. But if I don't know, North Korea declares war against the United States, they both go down. So that's called market risk. Okay. You can't eliminate market risk, no way. Okay. Market risk meaning all of the stocks in the United States would be affected by some terrible same exact news, American news. You understand what I mean?
Yeah, that makes sense.
Okay, that's called market risk. Okay, market risk is the risk that all American companies or all national companies in one country are exposed to same risk, okay, same danger, same problems, same difficulties. Say Federal Reserve chairman was poisoned, or president died, or there's a war, etc. These are all market risks. You can't eliminate this market risk. Okay, you can eliminate non-systemic risk by diversification. Okay, so you can diversify as much as possible. Perfect. Okay, just buy Twitter, buy auto, buy pharmaceutical. You can diversify, but you can't get rid of this risk. So it's always there. Okay, that's called market risk. Well, in finance, we learn how to decrease the diversifiable risk. We can't eliminate the market risk, but we can measure it. Okay, so we can measure how much a stock is linked to market. Okay, that's something called beta, which I will show you in a moment. Okay, so beta measures a stock's exposure to market risk. Okay, and it shows the stock growth relative to market. Okay, so similar to correlation, beta is a value around correlation is between -1 and +1. Beta can be between negative and positive, some number. But anyways, but the threshold is 1. Okay, so the threshold is 1. So it is if okay, in fact, if beta is 1, then the security or the stock is just as risky as the average stock. Okay, so here is so let me show you this graph. Okay, so here in this graph, maybe I should just prepare an empty sheet and then explain. So we calculate, let's say we have two numbers. Okay, say I have Apple and I have market risk. Okay, what is market? Market is the index, for example, S&P 500 index. It kind of measures all of the stocks in the market. Say Apple return is 2% and market return is 4%. Okay, so we draw a line here. Okay, and this is always Apple. Always the stock is on the y-axis. The market is always here. So Apple is 2%. So let's say this is July 1st. Okay, July 1st. Apple is 2% and market is 4%. So you put a dot here. And then July 2nd, Apple goes up by 3 more percent, goes up 5%. And then market goes up by to 9%. Okay, this is Apple is 5%, and then market is 9%. So you another dot. So you connect all the dots. Okay, this is scatter plot, and you draw a line. Okay, so this line represents how your Apple, how your stock is related to market. Okay, so basically this line is always can be expressed by an equation. Okay, so return of Apple is equal to say some number A plus B return market. Okay, so let me clear everything. So let me write this. Return of Apple is equal to 2 plus 0.5 return market. Okay, so let's give some numbers here. Assume market is 1. How much would be Apple? 1 times 0.5 plus 2 makes what?
2.5.
Perfect. Okay, so if market goes to 2, then it's going to be 3, right?
Yep.
Okay, so now let's take a look at what's going on here. Market increased by, so this is beta, right? So market goes up by 1 unit, okay? Apple increased by half unit, okay? Do you see this? This is a numeric example, okay? So I'm just like making up some numbers. Do you see this, that Apple, when market increased by 1%, Apple increased by 0.5%. Do you see that?
Yep.
It's not a coincidence that this is the same number, okay? 0.5%, 0.5%. Now, let's decrease market to 1% again. Okay. Now say the markets went down, Standard & Poor's, S&P 500 went down to 1. And then how much would Apple be? It's 2.5 again, right? So the market went down by 1, let's say -1. Now Apple went down by -5. Okay. So it's always 1 to half. Okay. So just because of this beta. Once again, so what I'm trying to tell you is when you draw, like put all the returns on a scatter plot and then draw a line, okay? The slope of this line is called beta, okay? So if beta, so now let's create another beta, okay? Let's say Amazon now is equal to 2 plus 1 times market return. Okay, now assume the market return is 4%. Okay, how much the Amazon would be?
6.
Perfect. Okay. Now let's increase the market by 1. Okay, 5. 5 times 1 is 5, plus 2 is 7, right? Which means the market increased by 1, right? The Amazon increased by 1 too, not half, okay? Just because the beta is 1. So the bottom line is this: beta measures how much stock, your own investment is related to market. If beta is one, it's 1 to 1. Then market goes up by one, the Amazon will go up by one. Okay. So if beta is one, your stock is as risky as the market. Okay. If your beta is less than one, then market goes up by one, your stock goes up by half. So it is half as risky as the market. Okay. If it is higher than one, then your stock would be more risky than market. So we measure the risk, the market risk of a stock by looking at beta. Okay. So let's go back to our chart again. So let's take a look at here. If beta is one, the security is as risky as the market. If beta is higher than one, well, this is the most dangerous thing you can get in finance. Okay, so this is real so dangerous. Oh, no way, don't do that. Okay, this stock is much more riskier than the market. If it is less than one, this is really good. I mean, if it's less than one, this is less risky than market. If kind of, let's continue my analogy. If I don't know, some president died, I mean, this stock with beta less than one would be affected less than a stock with beta one. Okay, just because if president dies or poisoned or something bad happens, the market collapses. And the stock with beta one would collapse too, but the stock with beta less than one would collapse less. Okay, does that make sense?
Yeah, that makes sense.
Okay, so now let's take a look at some examples. Okay, so let's look at those examples. Bank of America's beta is 1.8. You see that? These are from the book, by the way. It's a book statement. Now let me show you the reality just now, by the way. Okay, let's go back to our Bloomberg screen, which measures the beta of companies. So let's write here, Bank. Sorry. Let's write here, Bank of America. Okay, and then here it is. So this is Bank of America line chart, stock prices. Okay, and then let's write here beta. And let's calculate. So this is between October 1st, 2018 to September 1st, 2020. So it's last 2 years. So I can change it, but for the moment it's last 2 years. I can change it 1 year, fine. But this number here shows you the beta of the coefficient of X, shows you the beta of Bank of America. Remember, our book was saying it was 1.8. Remember, it's some years ago, by the way, it was 1.8. Nowadays, it is 1.3738. Okay. By the way, please make sure that you understand this from the Bloomberg screen too, because I might ask questions giving you the chart of. So I might just like give you a screenshot. Screenshot of any company, and I would ask you what's the beta of this company. So you would understand beta of this company either by looking at here, okay, it's the same thing, or by looking at here, they're the same numbers. So let's comment about this company once again. So this is Bank of America, a 1.39, which is almost 1.4, okay? So what would it tell us? So is this good to invest? How high is the market risk of this company? How high is the market risk of this company? 1.39. So if, for example, I would like to get rid of market risk, should I invest in this company or should I not?
I mean, it's a bit on the risky side, so.
Perfect. This company is hugely risky. I mean, it's extremely risky in terms of market risk. In terms of this company, market risk is huge. So if something bad happens in the country, if market collapses, this would collapse more than the market. Okay. When market collapse, look at the number there. It's X is market. If market collapses by one, remember my calculation? This would collapse 1.4, 1.39, more than the market. Okay. Now let's take a look at other companies. Okay. Say this, they invite you. Okay, let's get in. Oh, no, it's very close. Let's look at those companies. These are, okay, so these were high beta companies. These are high beta, which means these are high market risk. High market risk. Let's look at intermediate and moderate market risk. These companies. Okay, let's look at Best Buy, for example. Currently, as of now, as of today, Best Buy, and then okay, so do you see the beta of Best Buy from the graph? So what is Best Buy last 2 years beta?
Yeah, I can see it.
So what is it? What is it? Do you see this number here?
What was the question?
So what is the beta of Best Buy from the screen? Can you identify the beta of Best Buy from just looking at this number?
I think it says 1.393.
Perfect. It's exactly the same as Bank of America. Remember? So this is high market risk too. Okay, Best Buy has high market risk. Now let's take a look at some other companies. Now let's take a look at Procter Gamble. Okay, so when this chart was being prepared, I think it was 2013, the beta was very low. So now let's take a look at this year. Let's write here Procter Gamble, and then let's take a look at the beta. You see that it's 0.6, 0.58. You see that?
Yep.
This means that market risk of Procter Gamble is 0.6, which is good. It's less than 1. So the threshold or the criteria is 1. If it is 1, it is as risky as the market. If it is higher than 1, it means it's more risky than the market. Okay. If it is less than 1, okay, it's less risky than the market. So market risk. So I might safely say, looking at the last 2 years data, I might safely say that Procter and Gamble is, or Procter and Gamble has less market risk than the Bank of America has. Does that make sense?
Yeah, that makes sense.
Okay, so a negative beta means on average, a stock moves in the opposite direction of the market. A positive beta, whether it is higher than one or less than 1, they are moving in the same direction. Okay, but same direction for both Bank of America and Procter and Gamble, they are moving in the same direction with the market, but Procter and Gamble moves less in the same direction. Okay, so let me just show a totally hypothetical example. So assume this red line is market, okay, S&P 500 index. Okay, so when it goes up, so this is going to Bank of America. So Bank of America will go up more. When it goes down, Bank of America will go down more. When it goes up, Bank of America goes up more. So this is Bank of America. But now this is going to be Procter and Gamble. So when S&P goes up, Procter and Gamble goes up too, but less. You see that? More or less, they do the same movement. More or less, they do the same movement, but Procter and Gamble moves less than the market does. So this is less risky. Bank of America is high risky in terms of market risk. Okay, let's make sure that we are talking about the same thing. Okay, so we are talking about the market risk now. So this is Apple in 2018. Now let's take a look at Apple. Okay, Cassie, you tell me the beta of Apple, please. Okay, so I'm going to talk in beta. You identify the beta and tell me and interpret. Okay, now, so what is the beta of apple?
1.02.
Okay, it's very close to one, right? You can safely say that it's almost one. Okay, and then let's interpret it. What does it mean? If it is one, let's assume that it's one. Okay, so how can you interpret it?
So then if it was 1, it would be just about as average as the market. So as the market goes down, it would go
Okay,
down.
so that's basically it. So let me wrap up everything, and then try to make sure that nothing. Okay, so let me wrap up the things here. So we talked about three different things. Okay, the first one we talked about single stack. So if you have single stack, we take a look at. I'm sorry about this name tag. Keeps popping up. So we talk about expected return plus standard deviation, and then plus coefficient of variation. Expected return shows you your expectation from that stock in the future in terms of return. Standard deviation measures the risk. Okay. So this measures the risk. Coefficient of variation normalizes these two values. And then we talk about portfolio. Okay? So what if you have portfolio? If you have portfolio, you have to diversify with negatively correlated stocks. So this will decrease the unsystemic risk. But what if there's a systemic risk, which is called market risk? So for market risk, we measure market risk by something called beta. Okay, unsystemic risk is measured by standard deviation. Okay, standard deviation. Market risk is measured by beta. Beta is the criteria is one. Okay. If it is one, then it's unit market is as risky as market. If it is higher than one, it's more risky than one. If it's less than one, it's less risky than one. That's basically what we have done today. So let's talk about a couple of simple examples to make sure that everything is okay. So this is Apple. Once again, Apple's better. And then what else? Let's take a look at Amazon. This is Amazon. Can you identify the Amazon data?
0.702.
Which means that they are less risky or more risky than the market.
It's less than 1, so less risky.
Perfect. Okay. So what is the best measure of risk for a single asset and held in isolation? So if you have one only single asset, so which criteria do we use to measure the risk of that single asset? Okay. So say, for example, I'm talking about Amazon. I'm talking about their risk. Okay, just like single risk. Okay. That measure is variance or standard deviation. Standard deviation. If we are talking about portfolio, then did you answer my question, by the way?
If it's so, wouldn't it just be the standard deviation if it's just for a single?
Yeah, my question was, to see, for example, I have only one single stock. So what's the best measure of risk for a single asset held in isolation? Okay. And then if you have only one single risk, one single stock, then you can take a look at either its standard deviation or coefficient of variation. Okay, coefficient of variation is a standardized way of standard deviation. Okay, so I'm just like wrapping up, putting some music. Okay, from what we did today. But if you are talking about portfolio, if you are talking about market risk, then that's beta. Okay. This is what we see in the screen right now is called beta. Okay. Beta is measuring the market risk. Okay. Standard deviation or coefficient of variation is measuring a single asset held in isolation. Does it make sense?
Yep.
Okay. Well, I'm more or less done. I think, yeah, I'm done. If you have questions, you can ask. If not, so you have. So this is the last chapter, by the way. Okay. For the record, so this is the last chapter of the book. So we are basically done. So everybody, please watch these concept clips, and there are a couple of questions here. So just review the book, and then you are supposed to take the quiz. Okay, last week, which is about chapter 8, which is what people say. This is up to Sunday. So this week, this is going to be your assignment, so quiz 4, and then next week, there is no chapter left, but you have an assignment that which I'm going to next week, where it's not going to be a chapter. So this is going to adjourn the lecture part of the class.
Okay, so is it going to be like a review next week or just nothing next week?
Well, I will be here, so it will be I will be online here. Basically, I might make a short review. Well, not I will make a short review, but there's no class, so there's no specific lecture.
Okay, and then
So if you feel comfortable about the chapters, do not need to come. If you feel that you have some questions. Oh, by the way, you will have an end-term exam, and I published here a study guide for the end-term exam. Okay. So
okay.
it is going to be basically covering chapter 5, 7, and 8 only. Okay, 3 chapters.
Okay. And then when is the final exam open?
Oh, good question. So the class is supposed to finish on October 10th. So what if I give you a window of 3 days, like 7, 8, and 9? Would that be okay for you? I mean, I can be flexible, by the way, if you have any proposals.
Yeah, I think it should work.
So once again, this week you are supposed to take the quiz 4, okay? And there's only one assignment left, so there will be one assignment. So you have 3 assignments right now, and that should be 4. So you will have 4 assignments and 4 quizzes, and drop the lowest one of those, okay? So lowest quiz and lowest assignment. So for the moment, for this week, it's only quiz, okay? And by the way, I can tell you what the 4th assignment is. 4th assignment is here, quiz also here. 4th assignment is a video that I presented a paper last week here at the university. Watch the video, which is like 23 minutes, Q&A session, but you don't need to watch the Q&A session and just answer this question. Just write 1 page of essay. That's it, nothing else. So it's not a quiz, okay? It's just watch the video and answer the question. That's it. It's very easy. I can open it now on today so that we can both take the quiz and take the assignment this week, so that we can be left with only the end of the semester. Any questions, recommendations, suggestions? Okay. So,
No, none from me.
okay, Cassie. So hope to see you next week or whenever you want. Okay. Have a great weekend.
Thanks, you too.